Welcome to today's LinkedIn Live series. We created this series so that Fuqua faculty can share their expertise on current events. And so I'm very pleased to say that next week's LinkedIn Live broadcast will feature Professor Ashley Shelby Rosette, who will speak to us about how to foster equitable and inclusive workplaces during periods of great polarization, like the ones we're currently living through. I invite you all back here next week to discuss that topic with Ashley. Today, I'm going to talk about private equity during the current economic crisis. We've focused so much on the bad that's come from the coronavirus shutdown that I feel like we've overlooked the fact that there's both good and bad that's going on around us in terms of private equity and venture capital. There are definitely cash-starved companies out there, but many of these companies are in fundamentally sound businesses, industries that will bounce back when things turn around, even if that takes a while. And I know there's a lot of uncertainty about how long things actually will take to rebound. But there are a lot of excellent buying opportunities out there for private equity buyers. Let me give you an example. Take Apollo and Silver Lake's $1.2 billion equity stake in Expedia. Expedia is a household brand name in the travel and leisure industry, and we're ultimately someday going to start taking travel vacations again. That's an investment that could do very well. A few weeks later, Apollo announced a $300 million stake in a commercial printing company whose customer base consisted of a lot of small businesses that were really hammered by the shutdown. You take investments like this, and they could do very well once the economy begins to return to normal. And I want to stress that it's not just taking a bet on a stock price. By being a private equity investor, they're going to help these companies kind of re-engineer themselves to get to the new normal, which we don't know what that new normal will look like. But one of the roles that an activist investor plays in this environment is to play a role in helping companies transition. And so I think it's going to be interesting to see how this plays out. It's not just investments in companies that are temporarily stressed for cash like I've just described. There's also more fundamental investments out there. Intel Capital, to give you an example, the corporate venture arm of the tech giant Intel, is set to invest up to $500 million in tech companies this year, including ones that are working on a COVID-19 therapy. And fundraising has all but dried up for first-time funds, but if you're a brand name fund, if you're a seasoned, experienced fund out there, there's still fundraising that's going on. The statistics I have are that in the first quarter, VC funds raised a total of $21 billion this year. That's basically almost half of what was raised last year. Now, that said, there are also a lot of scary stories out there that we're hearing. I'm reading in the practitioner press stories about private equity firms who are worried that their institutional investors are not going to be able to honor the capital commitments that come up. So GPs, general partners, the private equity firms, they're trying to look for creative ways to help limited partners who are liquidity constrained institutional investors be able to get out from under their commitments in the least disruptive way possible. So, those are just some high-level examples of how there's both good and bad going on in the market, sort of across the entire ecosystem. There's no question that there's a tremendous amount of stress, but in the midst of that stress, there are interesting buying opportunities and investment opportunities of different types, across the value spectrum, from early stage VC to mid-market to growth to large established businesses. And so I think it's important, if we're trying to understand kind of what's the state of private equity and venture capital in the current market, I think you really have to embrace that complexity. Maybe now I should take some questions. We've got a question here. Can I say more about how the lockdown is more subtle than just this negative shock? And I'd be happy to. So, I mean, we want to remember that this lockdown that we put in place, what it did is it really exacerbated what was already a huge negative demand shock. And I'm choosing my words somewhat carefully here because there's evidence out there that people were already starting to self-isolate before the mandatory lockdowns went into place. And it's that self-isolation that created the negative demand shock that's taken place. And life is not going to return to normal once things are lifted. But in addition to the demand shifting, there's also been a big change in the composition of demand. And this has done a couple of distinct things. It's created a huge cash crunch for all kinds of firms in the economy, but it's also created a spike in demand for certain types of businesses, certain business models. It's created, I think everybody recognizes that it's created a lot of uncertainty surrounding the viability of certain businesses, especially when we think about how we don't know how long it's going to take to return to the new normal. But it's also removed a lot of uncertainty. It's acted like as a catalyst. It's bringing about an increased swiftness to the demise that some business models were already experiencing. And we're seeing that with more, retail, the retail sector in particular, companies that were struggling to begin with that maybe had some possibility of hope, that's over. So I've got a great question here from Doug Dickerson, an alum. Hi, Doug. It's great to have you here. There are some bad examples from private equity buyouts, and you've got ones like Chrysler, JCPenney, Toys R Us. Maybe Toys R Us is like the shining example, the poster child of bad acquisitions. When they buy distressed companies, leverage them more. What are thoughts about this? So I think it's important to recognize that a lot of the anecdotes that we have about private equity come from specific moments in the business cycle. And so it's easy to look at a transaction like Toys R Us, which was done at the very peak with a tremendous amount of leverage, and say, oh, well, that leverage made it impossible for that firm to innovate. And that's one specific example in which things worked out poorly ex post for Toys R Us. And it's very hard to take. It's very hard to know where exactly to lay the blame in the failure of that transaction. But what's clear is that when you look at things that are happening at the very top of the market, that's where you're going to see lots more of the over-levered things turning out badly. And it's partly just because acquisition prices are being driven up. So I think that leverage is going, first of all, I think we're in a lot less danger for those type of transactions in the current environment because prices have collapsed and deal-making activity is becoming much more frugal and much more cautious. And so that's taking away a lot of the flames from the competition that's driving up prices and driving up the reliance on debt in these transactions. So those are just kind of my quick thoughts. I'm happy to take some more questions. A lot of questions are coming up here, sort of people saying sort of aren't familiar with private equity and sort of who are the distinct players here. And I apologize if I got too much into the lingo at the beginning. You basically got three sets of distinct actors in this ecosystem. You've got private equity portfolio companies. In other words, the operating companies out there who receive investment capital from either venture or growth equity or buyout firms. So that's the Expedia receiving the $1.2 billion equity injection from Apollo and Silver Lake. So those are portfolio companies. Then in the middle, you have the private equity firms, and they're actually spending other people's money in large part. They raise capital from limited partners who are typically institutional investors, big pension funds, university endowments, sovereign wealth funds, institutions of that ilk. And so these three distinct players, the limited partners who are providing capital, the private equity firms who are finding investments, and the portfolio companies who are receiving invested capital, they're all kind of experiencing this crisis differently. So here's a question from Lindsay, an alumna in Kansas City. Hi, Lindsay. She's heard some firms have had an investment freeze. What are the signposts for them to lift the freeze? So I think that's a great question, and it really gets to the core of kind of the technical difficulties that some private equity firms are facing when they're trying to execute some of the investments that they'd like to make. Because they're limited partners, these institutional investors, many of them are really scrambling for cash. And so think about it, if you're a university endowment, you're suddenly worried about all the economic pressure that universities are facing. And so that, causes you to want to conserve capital and not want to provide it. So, I think funds are going to lift an investment freeze. I think these investment freezes will partly be lifted when we begin to see more clarity around what a reopening starts to look like. I think a lot of people are holding their breath because they know there's going to be a resurgence of the virus, and they don't know quite how we're going to organize our economic activity because we don't know when that's going to occur relative to the development of various therapies and various medical responses to it. So the interplay of those things is what's giving people pause. And I expect that when we start to have more clarity on that, there's going to be competition among private equity firms to sort of be the first out of the gate to kind of get back in and make investment. So Rob, hi, Rob Brewster. Rob is an alum from Seattle. Do I think that the PPP has done what it was intended to do? Should it have been done in 2008? I don't necessarily, maybe it should have been done in 2008. I'm not sure. I think that, I have somewhat of a contrarian perspective on the whole payroll protection plan thing, and it's informed by two observations. One is that if you look at the so-called 30 million small businesses out there, there's only about 6 million of them who have employees. The vast majority of them are non-employer firms, solo shops. And so I think there's a fine line between offering payroll protection plan to someone who has 0 or 1 employees versus just helping that person with a paycheck, with income support. So secondly, I'm hearing people in the media talk about the payroll protection plan being a failure because we're still seeing a lot of business closures. And here, the uptake of it has not gone in the direction that people have thought. And I think it's incredibly important to remember some basic facts about the small business economy, which is that there is an incredible amount of turnover in the small business economy. So we should not look at failed business failure itself as a bad thing. We should see it as part of this economic churn that happens every day in the small business sector, all across the country, all across different sectors. And it's that churn that's really critical for creating jobs. And so the fact that we're seeing closures, we're seeing closures. What I'm more eager to see is what's the rate of new business formation, and when are we going to see that start to pick up? And I think that's going to be a much stronger barometer of whether the payroll protection plan has done what it was intended to do. I guess my personal, short answer to your question, my personal inclination would be to lean away from payroll protection plans towards household income support so that people could jumpstart things more quickly. Let me see. Got a couple of questions here. There's a question from Robert Ross in Raleigh. Hi, Robert. Have the structure of deals changed in the recent environment? Yeah, I mean, as far as I know, and here's where, I'd rather lean on actual data from practitioners down on the ground. But what I'm, kind of seeing at a high level is that you're seeing much safer deals being done, deals that have more preferred equity, less debt, things. The deal making has gotten more conservative, and people are thinking more carefully about how the cash is going to be used. I mean, I think it's important to recognize that private equity injects cash into businesses, and then it attaches to that, operational assistance, or whatever you want to call it. I mean, it's part cash and part management that's happening. You talk to people in the mid-market private equity space, they'll tell you that, when they make an investment in a company, a lot of times what they do is not necessarily cut cost on the shop floor. It's help the management team be more effective. And so I think I think you're gonna see the structure of deals changing in the recent environment, in terms of how they think about what types of assistance that management teams need in order to survive this. Let me see here. Arjun, hi. He has a question. When looking at middle market private equity, do we expect median debt to EBITDA ratios to rise drastically in the near term due to lack of revenue, and therefore triggering lots of defaults? So yeah, this is a tough one. I mean, I think partly this is the uncertainty that we were talking about earlier, and this ties back to kind of the thoughts about how deal making has changed. I think you're going to see debt. I mean, there's no question that EBITDA is going to be dropping, and that's going to cause this ratio to rise, as you point out. So same amount of debt, less revenue, meaning less EBITDA. That makes the company look a lot riskier, and it puts it near the brink of failure in terms of violating these various default covenants. I think there's going to be enormous pressure to renegotiate those. And this is where I think research has something to say about this. The research out there shows us that private equity-backed companies, when they face covenant violations that sort of push them towards bankruptcy, they're much more likely to emerge from that process with the current management team intact. And that's because private equity is, unlike firms that are over levered but don't have private equity backers, the ones that do have private equity backers, they have investors, these private equity firms, who are very familiar with negotiating with lenders. And so the power of PE to facilitate renegotiation is, I think, going to be an important thing that's going to help mitigate the surge of bankruptcies. Manju, hi Manju. Manju wants me to talk about the effect of globalization due to COVID. Thank you for the question, Manju. So I think this is where things get really interesting, and I think where we're talking about there being a shift in the composition of demand, not just the level of demand. There's no question that global supply chains are going to become reconfigured as a result of this crisis. There's been short-term reconfiguration, but there's going to be more long-term reconfiguration of global supply chains, and that's going to create an enormous amount of opportunity as business starts to come back on shore that had been offshored. And so I think that private equity has a really important role to play in this, because they're going to be sort of down in the weeds looking at mid-market companies that are, they produce a small part in a much bigger engine, and they're an important part of the supply chain, but they're going to get private equity capital in response to the surge in demand that they're going to experience from this reconfiguration. So I see globalization as part of this story about the changing composition of demand. And I think it's extremely complicated because you have consumers in global markets, and you have producers in global markets, and seeing how all that reshifting comes about. Private equity has always been the handmaiden of technological change and economic change, and we're going to see a lot of that play out. Jor Janssen, a visiting student, a recent graduate from the Stockholm School of Economics, asks, do we have any thoughts about how private equity-backed portfolio companies will handle the crisis versus public companies in terms of financial performance? I think a lot of just the raw accounting numbers that we're going to be seeing out of private equity versus public equity companies are just going to be driven by top line revenues and how well they're able to manage, midline costs. I think that where there's a difference is that if you have a private equity backer, hopefully you have a source of patient capital. And so if you don't face the scrutiny of public capital markets, hopefully you can make more difficult choices that bring the company to a better place sort of in the medium term as things begin to turn around. So an example of that might be, a private equity-backed company being in a better position to build out a management team to address changes that are occurring in the market, whereas a public company may be struggling and to make those kind of changes in the scrutiny of the public eye. Let me see. So given Kola Papula, I apologize, Kola, if I'm mispronouncing your name, but Kola Papula from KPMG is asking, given the impact of COVID on the airline industry, would we expect to see more PE firms enter the airline industry space? So I know a little bit about this space firsthand from some advisory work that I've done with private equity companies in the space. So first of all, a lot of airlines lease their airplanes from leasing companies, and private equity has played an important role in providing capital to these leasing companies. What I'm hearing from my friends on the ground in private equity, people at organizations like Quorum Capital, which has Duke alums on the management team, they're telling me that right now they're having to renegotiate rental agreements with airlines. It's very common in this kind of situation. It happened after 9/11, where you have a huge drop in demand for air travel, and you basically negotiate a workout where you can temporarily pause the rental payments that they're making, the lease payments that they're making on the planes, in exchange for interest on that and picking up on the back end. So I know that that's happening. I also know that the PE firms that are operating in the space see a lot of attractive buying opportunities. And so I would expect that. So there's buying opportunities at a couple of levels. There's buying opportunity, like if you're an airplane leasing organization, you'll be able to purchase airplanes more cheaply than you would have otherwise. And in the long run, that'll play out well for your investors. But there's also, companies operating in this space, companies that do the maintenance and repair that allow you to turn the planes around, all part of that, sort of back end of that industry. And I would expect to see a lot of private equity entry into that market to try to think about creative ways to reconfigure the way that industry operates. Hi, Nick Musali. Good to see you on the call. How will the threshold for due diligence change, if at all, given the current and future restrictions on travel? Wow, I had not thought of that. I'm guessing that you're going to see a lot more due diligence take place like this, but that's not going to be good enough for certain types of activities. And so I think that what's going to happen is it's going to slow things down a lot, because some due diligence you just have to be on site and on the ground to do, and you're not going to be able to close a deal until you can look people in the face and actually kick the actual tires, not kick them metaphorically, but actually put your foot against them. And that process is slowed down. There's no question about that, and that is that is going to be a challenge, and I think it will. I think it will slow down deal execution. I think one of the things that it could do is it could change the way that partnerships work. And what I mean is sometimes PE firms. Well, I gave you an example of this at the beginning with Expedia. That was um, Apollo and Silver Lake together investing. That's very common to see, private equity firms investing with one another. And I think that, maybe one way around the due diligence is finding local PE shops that can help cut the travel down. So that's my best guess there. But I mean, we're kind of guessing still. Tina Dimitrova from Germany. Nice to have you on the call. I guess it's not lunchtime there, it's dinner time. What are we seeing on the healthcare side in terms of assets, valuations, and deal making? Yeah, that's a great question. I mean, I think that there's a lot of interest in the types of healthcare that are responsive to the crisis that we're facing. And, I don't know. I mean, it's hard for me to answer your question with a lot of concrete details around what the terms are looking like. But I can just tell you that there's a lot of interest in this. The payoff is enormous for the innovations that are going to bring about therapies, cures, and preventions to the coronavirus. But in addition to that, you've got everything else that's taking place as hospitals are being reconfigured and we're rethinking how things, how things work on a practical day-to-day basis. And so that's creating a tremendous amount of interest in the space. Okay, we're running pretty close on time, and so maybe I'll take this final question, and then perhaps I'll wrap up. Given that the U.S. this is from Samri Nagia at Deloitte in Haryana, India, and I apologize if I didn't pronounce your last name correctly, or your first name for that matter. Given that the U.S. has only started emerging from the household debt slump, and COVID is causing a demand contraction, will firms look for investment in emerging economies? And I think the answer there is undoubtedly yes. But I think there's an important caveat here. That wait a second. The wait a second is that the demand contractions in emerging economies are going to be greatly impacted by those own countries' ability to respond to the crisis on the ground in the country. And so, like Brazil is having an enormous amount of challenges. And so where, absent, if it was just about a household debt slump in the US, I would say undoubtedly you're right. We'd see a huge amount of capital being pushed into emerging economies. But emerging economies often have emerging healthcare systems, and that's going to put them under a huge amount of strain. So I think that's a big kind of if that we have to hang on to when we think about that. Okay, we're here at the top of the hour, and I know that we have a hard stop at 1. So let me close there, and let me just say a couple of things. First of all, thank you for joining us. Thank you for your questions. It is great to reconnect with alumni, and friends in these crazy times that we live in. And I just really appreciate the chance to get to reach out and speak to you guys. Thank you for joining us today. Please come back next week to talk with Ashley Shelby Rosette, who again, is going to talk about how to foster inclusive workplaces in these times of great polarization. I think it's going to be a great conversation. And also follow Fuqua on LinkedIn so that you can be notified of future events like this one. Thanks a lot and have a great day. God bless you all and stay safe.